The credit score never arrives with a knock on the door. It never announces itself. It simply changes. A few points disappear. A loan suddenly costs more. An application gets denied. A credit card offer never comes. Most people assume that's just how the system works. My grandfather didn't. He spent 38 years balancing the books for a small farm supply business where every dollar had a purpose. He wasn't a banker. He wasn't a financial advisor. He never worked for a credit bureau. But he believed something that sounded almost impossible the first time I heard it. He believed your credit score wasn't changed only by how much you paid. It was changed by when you paid. I laughed the first time he said it. I told him a payment was a payment. He just smiled and reached into an old oak filing cabinet that had followed him through 3 different houses. Inside were tax receipts, canceled checks, mortgage statements, warranty cards held together with fading rubber bands, and beneath them all sat a thin manila folder with 6 words written neatly across the front. The calendar beats the interest. At first I assumed it contained old budgeting notes, maybe reminders about due dates, maybe records from when interest rates were much lower. I was wrong, because every page inside described something most people never think about: statement dates, payment dates, reporting cycles, grace periods, balances, timing. One page contained only a single sentence: "The bank counts before you think it does." I read it twice, then a third time. I still didn't understand. The deeper I read, the stranger the folder became. There were no secret accounts, no illegal tricks, no fake identities, no schemes to fool the banks, just ordinary habits, done on different days of the month. And according to Grandpa, those few days could quietly change how lenders saw you, even when you never missed a payment. Grandpa used to say something that puzzled me for years. The system doesn't need to hide the calendar. It only needs people to ignore it. Looking back, I think that's exactly why so few people ever talked about statement dates. The due date gets all the attention. The reporting date quietly does its work in the background. That was the part I couldn't stop thinking about. If millions of people faithfully pay their bills every month, why do some build strong credit so much faster than others? What exactly was Grandpa seeing that everyone else overlooked? Stay with me. Because the first page in that old folder wasn't about borrowing money at all. It was about a calendar hanging on the kitchen wall. And according to Grandpa, one date on that calendar quietly mattered far more than the due date printed on the bill. But before I show you what he discovered, you need to understand one sentence he wrote over and over again in the margins of nearly every page. Banks measure habits. The calendar reveals them. At the time, I thought Grandpa was talking about budgeting. I had no idea those 6 words would eventually explain why 2 families earning almost the same income could end up with completely different credit scores. Grandpa's folder contained dozens of old credit card statements. Not because he carried debt, quite the opposite. He kept them because they proved something. Every month he had circled 2 different dates in red pencil: the payment due date and another date most people never noticed: the statement closing date. According to Grandpa, that second date quietly shaped the picture lenders saw long before the payment deadline ever arrived. One afternoon, years before online banking existed, he stopped at the local bank to ask a simple question. Not about interest, not about credit limits. Just one question: when do you tell the credit bureau what I owe? The young teller didn't know. Neither did the branch manager standing a few feet away. A few minutes later, another employee disappeared into the back office and returned with an older supervisor. The man smiled politely and said something Grandpa never forgot. "We report your balance after the billing cycle closes." Grandpa thanked him, folded the brochure they handed him, and walked back to his truck. He later wrote only 5 words beside that memory. That's when the picture freezes. At first, I didn't understand what he meant. A balance was a balance. Or so I thought. But Grandpa believed the bank wasn't watching your account every second of every day. It was taking snapshots. One snapshot each billing cycle. And whatever balance appeared in that snapshot was often the number lenders would see. Not the balance a week later. Not the balance after payday. Not the amount you plan to pay before the due date. The balance on that reporting day. That single idea changed the way he used every credit card for the rest of his life. He never chased reward points. He never worried about fancy metal cards. Instead, he kept a small paper calendar beside the kitchen telephone. Whenever a statement arrived, he wrote down 2 dates. One for when the statement closed, another for when the payment was actually due. Then he counted backward, not forward. That was the part that puzzled me. Why count backward? Why not simply pay on the due date like everyone else? Grandpa smiled the same way he always did, when he knew the answer would sound too simple. Because, he said, once the picture has been taken, changing your shirt doesn't change the photograph. I didn't fully understand what he meant until years later, when I compared 2 statements sitting side by side on his kitchen table. They looked almost identical. The same card, the same spending, the same payment, yet one small difference quietly changed everything. And what I discovered on those 2 statements completely changed how I think about credit scores. Stay with me. Because those 2 pieces of paper revealed the $0 timing trick Grandpa believed most people never notice, not because it's hidden, but because almost nobody is looking at the right date. I spread the 2 statements across Grandpa's kitchen table. At first glance, they looked identical. Same credit card, same grocery store, same gas station. Even the total amount he'd spent that month differed by less than $20. But Grandpa wasn't looking at what he'd bought. He pointed to a small line near the top of the page that most people skip without ever reading. Statement closing date. Then he pointed to another line farther down. Payment due date. There, he said quietly. That's where most people get fooled. I still didn't understand. The due date was almost 3 weeks later. Like most people, I'd always assumed that was the only date that mattered. After all, if you paid before the due date, you were doing everything right. At least, that's what I believed. Grandpa shook his head. The due date keeps you out of trouble, he said. The closing date tells your story. Those words stayed with me. Years later, I finally understood why. Imagine taking a photograph of a bookshelf. The moment the camera clicks, that's the picture everyone sees. You can rearrange every book 5 minutes later, but the photograph doesn't change. Grandpa believed credit worked much the same way. The statement closing date was often the moment the lender recorded how much of your available credit you were using. That information could then be reported to the credit bureaus, depending on the lender's reporting schedule. Paying before the due date could keep you from paying interest. But paying before the statement closed could sometimes mean a lower reported balance appeared in that monthly snapshot. T wasn't magic. Grandpa smiled whenever people called it a loophole. They're right, he used to say. Not because it breaks the rules, because almost nobody bothers to learn them. The timing was always there. Printed on every statement. Most people simply never realized those dates could quietly change the picture lenders saw. Grandpa called it cleaning the window before the visitor arrives. One month he tried a simple experiment. He used his credit card for nearly everything. Groceries, fuel, feed for the chickens, supplies for the workshop. A few days before the statement closed, he made a payment that brought the balance down dramatically. Then, he waited. When the statement arrived, the reported balance was far lower than the amount he'd actually spent during the month. He smiled, folded the statement, and slipped it into the same manila folder. Beside it, he wrote one short sentence. The calendar saved more than the money. At first, that sentence confused me. How could a calendar save anything? It couldn't lower interest rates. It couldn't erase debt. It couldn't make purchases disappear. But Grandpa wasn't trying to spend less. He was trying to let the bank see a different picture of the same responsible habits. That may sound like a small distinction. According to Grandpa, it was one of the biggest differences in personal finance. Because banks don't just look at whether you pay. Grandpa believed that wasn't an accident. Most people spend all month thinking about avoiding late fees. Very few spend even 5 minutes thinking about what balance gets reported, and when everyone focuses on the wrong date. The system never has to explain the other one. That was when I noticed another folded page tucked into the back of the folder. Unlike the others, it didn't mention credit cards at all. It mentioned something almost every family does without thinking: payday. And according to Grandpa, that ordinary day on the calendar could quietly work for you or against you, depending on one simple decision. What he discovered next made even more sense than the timing trick itself, and it explains why two people earning the same income can build very different financial reputations over the years. For years, I thought Grandpa's calendar was just another one of his old habits. Every month looked almost the same. Tiny pencil marks, small circles around certain dates, short notes in the margins that made no sense to anyone but him. 3 days. Don't wait. After payday. One afternoon, I finally asked him why he never paid his credit card on the due date. He smiled without looking up from the newspaper. Because, he said, the due date is for avoiding trouble. He folded the paper and tapped the calendar hanging beside the refrigerator. But this is where you build trust. That sentence stayed with me. A few months later, I decided to compare his calendar with one of his old statements. That's when something jumped out that I had completely missed. His payday almost always came before the statement closing date. Not by accident, by design. Grandpa had arranged his routine so that whenever possible, he'd make a payment shortly after getting paid, before the billing cycle ended. He wasn't trying to impress the bank. He was making sure the balance reported on his statement reflected what he actually intended to carry, not simply what happened to be on the card a few days earlier. He once wrote a sentence in the margin that explains it better than any financial article I've ever read. Don't let yesterday's spending become tomorrow's reputation. The more I thought about those words, the more they made sense. Many families treat payday as permission to start spending again. Grandpa treated payday as an opportunity to reset. He'd look at the calendar before he looked at the balance. If the statement was about to close, he'd pay what he comfortably could before that date. If it had already closed, he'd focus on paying by the due date to avoid interest. Same paycheck, same amount of money, different timing. And according to Grandpa, timing had a way of quietly changing the story your account told month after month. He wasn't chasing perfection. He knew emergencies happened. He knew some months were harder than others. What mattered wasn't making a giant payment once. It was building a rhythm that worked over years. Looking back, I think that's why he never described it as a trick. He called it a habit. The trick was that almost nobody realized when the habit mattered most. Then, tucked inside the back of the folder, I found a folded receipt with just 4 handwritten words across the top. Never make the bank guess. At first, I thought he meant paying every bill on time. But what those 4 words really meant turned out to be the lesson that tied every page in the folder together. And once I understood it, I realized Grandpa had never been trying to outsmart the banks. He was making sure his financial story was clear before anyone else got to read it. There was one final page inside Grandpa's folder. Unlike the others, it wasn't filled with dates. No payment amounts, no account numbers, no calculations. What happened next completely changed the way I looked at credit. Just one sentence, written slowly in faded blue ink. Time is the one thing the bank cannot charge interest on unless you give it away. I stared at those words for a long time. At first, they sounded like something about patience. But the more I thought about everything Grandpa had taught me, the more I realized they explained every page in that folder. The calendar, the statement closing date, the payment date, the habit of checking his accounts after payday. None of those things cost him $1. They simply helped him decide when his money should move. That was the $0 timing trick. Grandpa never claimed he'd found a loophole that fooled the banks. He believed he'd found something even better. A timing advantage hiding in plain sight. The rules never changed. The calendar never changed. Only the people who understood them. Grandpa never believed banks were afraid of people borrowing money. Banks expect that. What they quietly benefit from is confusion. When people only notice the due date, when they never learn the difference between paying on time and reporting a lower balance, when they assume every month begins and ends the same way, they stop managing the calendar. And the calendar begins managing them. Grandpa refused to let that happen. Once a month, usually after supper, He'd sit at the kitchen table with a pencil, a cup of coffee, and that old paper calendar. He wasn't chasing a perfect credit score. He wasn't trying to impress anyone. He was making one small decision before the system made it for him. Looking back, I think that's why his financial life always seemed so calm. He didn't know every investing secret. He didn't predict the stock market. He wasn't wealthy because of some hidden formula. He simply paid attention to small moments that most people walked right past. One note near the back of the folder has stayed with me more than all the others. A good reputation isn't built on the day you borrow. It's built on the days nobody is watching. Maybe that's the lesson this old folder was trying to teach all along. Credit isn't just about numbers. It's about habits. Habits become patterns. Patterns become trust. And trust, whether it's earned with a neighbor, a friend, or a lender, is almost always built quietly. Today, there are apps that send reminders, dashboards that track your score, alerts that tell you when something changes. Those tools are useful, but none of them can replace paying attention. None of them can choose the right day for you. None of them can build the habit. Only you can do that. Sometimes I wonder what Grandpa would think if he saw how many people check their credit score every week, but never check the date their statement closes. I have a feeling he'd smile, tap the calendar hanging on the wall, and say the same thing he wrote all those years ago. The score doesn't begin at the credit bureau. It begins on your calendar. That old manila folder now sits inside the same oak filing cabinet where I first found it. The paper has yellowed. The corners are soft. Some of the pencil marks have almost disappeared. But every month, before one of my own statements closes, I open that folder again. Not because it contains a miracle, because it reminds me that the biggest financial advantages are often the quietest ones. The banks already know when they're taking the picture. Now you do too. And perhaps that's the one piece of knowledge Grandpa hoped would never stay buried inside an old folder. Because sometimes the smartest way to improve your financial future isn't by earning more. It's by understanding when your money tells its story.